Question 1. Operational review demonstrates that a new short-term disability (STD) insurance product is being considered for market launch. The proposed product features an elimination period of 30 days and a benefit period of 90 days. The product is intended to provide income replacement for employees who are temporarily unable to work due to non-work-related illnesses or injuries. The AFLMI regulatory framework mandates that disability insurance products must have clearly defined and reasonable elimination and benefit periods to ensure policyholder understanding and fair market practices. Which of the following approaches best aligns with the regulatory requirements for designing this short-term disability insurance product? Option A. Offer a benefit period that continues as long as the insured remains disabled, with no defined maximum duration. Option B. Utilize an elimination period that is not explicitly stated, but is understood to be the first 50% of the potential benefit payout. Option C. Implement the proposed 30-day elimination period and 90-day benefit period, ensuring these terms are clearly communicated in policy documents. Option D. Set the elimination period to be equal to the benefit period to minimize insurer risk. Correct answer is C. Implement the proposed 30-day elimination period and 90-day benefit period, ensuring these terms are clearly communicated in policy documents. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the application of specific regulatory requirements concerning the design and administration of disability insurance products, specifically focusing on the interplay between elimination periods and benefit periods. Misinterpreting or misapplying these regulations can lead to non-compliant product offerings, potential regulatory sanctions, and financial harm to policyholders. The challenge lies in ensuring that the chosen elimination and benefit periods align with the intent and letter of the Associate Life Management Institute (AFLMI) regulatory framework, which prioritizes consumer protection and fair market practices. Correct approach analysis. The correct approach involves selecting an elimination period and a benefit period that are clearly defined, reasonable, and compliant with the AFLMI regulatory framework. This means the elimination period should be a specified waiting time before benefits begin, and the benefit period should be a defined duration for which benefits are paid. The AFLMI framework, while not explicitly detailed here, generally emphasizes clarity and fairness in insurance contracts. Therefore, a combination that clearly delineates these periods, ensuring policyholders understand when coverage starts and how long it lasts, is compliant. This approach upholds the regulatory principle of transparency and ensures that policyholders receive the benefits they are entitled to under the terms of their policy without ambiguity. Correct approach is analysis. An approach that uses an undefined or excessively long elimination period without clear justification or regulatory allowance would be non-compliant. This failure stems from a lack of transparency and potentially creates an unreasonable barrier to accessing benefits, violating principles of fair contract design. An approach that offers an indefinite benefit period without any stated maximum duration is also problematic. While seemingly generous, it creates significant actuarial and financial risk for the insurer and can lead to unpredictable liabilities. Regulatory frameworks typically require defined benefit periods to ensure financial solvency and predictable product offerings. An approach that links the elimination period directly to the benefit period in a way that effectively negates the benefit, e.g., an elimination period that is almost as long as the benefit period, would be considered misleading and potentially exploitative. This misrepresents the value of the coverage and fails to meet the spirit of providing meaningful disability protection. Professional reasoning. Professionals should approach this by first thoroughly understanding the specific AFLMI regulatory guidelines pertaining to disability insurance product design, particularly regarding elimination and benefit periods. They must then evaluate proposed product structures against these guidelines, ensuring clarity, reasonableness, and compliance. A systematic review process, potentially involving legal and compliance departments, is crucial to identify any potential conflicts with regulatory requirements. When in doubt, seeking clarification from regulatory bodies or experienced legal counsel specializing in insurance law is a prudent step. The decision-making process should prioritize consumer protection and adherence to the established regulatory framework over aggressive product design that might push the boundaries of compliance. Question 2. Market research demonstrates that employers are increasingly seeking cost-effective group life insurance solutions. A potential client, a small business with 50 employees, has expressed a strong preference for the lowest possible premium for their group life insurance policy. They are primarily interested in a basic term life insurance offering. However, the employee demographics suggest a significant number of employees have young families. What is the most professionally responsible approach to recommending a group life insurance solution? Option A. Propose a comprehensive group life insurance package that includes substantial accidental death and dismemberment (AD&D) benefits and extensive dependent coverage, as this offers the broadest possible protection for all potential scenarios. Option B. Recommend a basic term life insurance policy with a death benefit equal to 1 year's salary for each employee, as this directly addresses the employer's primary concern for cost-effectiveness and provides a foundational level of protection. Option C. Advise the employer that group life insurance is a commodity and that they should simply select the cheapest policy available from any provider, as the AFLMI regulatory framework does not mandate specific coverage levels for group life insurance. Option D. Conduct a detailed needs analysis of the employee group, considering their family structures and financial responsibilities, and then present a tailored recommendation that balances cost-effectiveness with adequate protection, potentially including options for term life, AD&D, and dependent coverage based on the findings. The correct answer is B. Recommend a basic term life insurance policy with a death benefit equal to 1 year's salary for each employee, as this directly addresses the employer's primary concern for cost-effectiveness and provides a foundational level of protection. Explanation: this scenario is professionally challenging because it requires an insurance professional to balance the client's immediate needs and perceived benefits with the long-term implications and regulatory requirements of group life insurance products, specifically concerning dependent coverage. The core challenge lies in accurately assessing the suitability and understanding of the proposed coverage, ensuring it aligns with the group's actual needs and the principles of group insurance, while adhering to the AFLMI regulatory framework. The correct approach involves a thorough needs analysis that extends beyond the employer's stated desire for a low-cost option. It necessitates understanding the demographics of the employee group, their typical family structures, and the potential financial impact of death or dismemberment on dependents. This approach is correct because it prioritizes the fiduciary duty to the client, the employer, acting on behalf of the employees, by ensuring the recommended product provides meaningful protection. Specifically, it aligns with the AFLMI emphasis on suitability and responsible product placement, which implicitly requires that group insurance offerings genuinely serve the intended beneficiaries. Offering only basic term life without considering the potential for accidental death or dismemberment, or the specific needs of employees with dependents, could lead to underinsurance and unmet financial security goals for the group. An incorrect approach would be to solely focus on the employer's stated preference for the lowest premium without further investigation. This fails to meet the professional obligation to ensure the product is suitable for the group's needs. Ethically, it prioritizes a transactional outcome over the well-being of the insured individuals. From a regulatory standpoint, while not explicitly prohibited by a specific AFLMI rule in this context, it violates the spirit of responsible insurance provision, which is underpinned by principles of fairness and adequacy of coverage. Another incorrect approach would be to recommend a product that includes extensive accidental death and dismemberment benefits and dependent coverage without first confirming the employer's budget and the group's specific risk profile and needs. While well-intentioned, this could lead to recommending a product that is unaffordable or unnecessarily complex for the group, potentially leading to lapse or dissatisfaction. This approach fails to demonstrate prudent financial stewardship and may not be the most efficient use of the employer's resources for the group's overall protection. A third incorrect approach would be to assume that all group life insurance policies are inherently adequate for any group without customization. This overlooks the diverse needs of different employee populations and the specific features of various group life products, including the nuances of term life, AD&D, and dependent coverage. It represents a failure to engage in the due diligence required to match the product to the group's unique circumstances, potentially leading to a mismatch between coverage and need. The professional decision-making process for similar situations should begin with a comprehensive understanding of the client's objectives and constraints. This involves active listening, asking probing questions about the group's demographics, financial capacity, and potential risks. Following this, the professional must conduct a thorough needs assessment, evaluating how different product features, term life, AD, and D, dependent coverage address those identified needs. Finally, the professional should present a range of suitable options, clearly explaining the benefits, limitations, and costs of each, enabling the client to make an informed decision that aligns with both their stated goals and the principles of sound insurance practice. Question 3. Market research demonstrates that many individuals approaching retirement are concerned about minimizing taxes on their retirement income and planning for potential estate taxes. A client, age 62, has expressed a desire to reduce their current taxable income and ensure their assets are passed to their beneficiaries with minimal estate tax liability. They have a moderate income and a substantial portfolio of taxable investments, as well as a life insurance policy with a significant cash value. Considering the U.S. regulatory framework for retirement and estate planning, which of the following strategies best aligns with the client's objectives while adhering to tax laws? Option A. Suggest that the client aggressively withdraw funds from their taxable investment accounts to cover living expenses, thereby reducing their taxable estate and current income. Option B. Advise the client to gift their entire life insurance policy to their adult children immediately to remove it from their taxable estate, without considering the tax implications of policy ownership transfer or future cash value growth. Option C. Advise the client to maximize contributions to tax-deferred retirement accounts, explore Roth IRA conversions based on current tax bracket projections, and review the life insurance policy for potential tax-efficient withdrawal or loan strategies to supplement retirement income and manage estate value. Option D. Recommend liquidating a significant portion of the client's taxable investments to purchase more life insurance, with the primary goal of increasing the death benefit for estate tax reduction. The correct answer is C. Advise the client to maximize contributions to tax-deferred retirement accounts, explore Roth IRA conversions based on current tax bracket projections, and review the life insurance policy for potential tax-efficient withdrawal or loan strategies to supplement retirement income and manage estate value. Explanation. This scenario presents a professional challenge because it requires balancing a client's desire to minimize immediate tax burdens with long-term estate planning goals, all within the specific regulatory framework governing life insurance and retirement planning in the United States. The AFLMI designation implies a focus on U.S. regulations. A key challenge is ensuring that recommendations are not only tax-efficient, but also compliant with IRS rules regarding retirement income and estate taxes, avoiding potential penalties or unintended consequences for the client. The correct approach involves a comprehensive review of the client's entire financial picture, including their current income, anticipated retirement income sources, and their estate value. This approach prioritizes understanding the client's specific circumstances and goals before recommending any strategy. It then involves leveraging tax-advantaged retirement accounts and life insurance products in a manner that aligns with IRS regulations for both income and estate tax mitigation. Specifically, utilizing qualified retirement plans like 401(k), S, and IRAs to their maximum potential, considering Roth conversions if appropriate based on current and future tax brackets, and strategically using life insurance for estate liquidity or wealth transfer, all while adhering to contribution limits and distribution rules, represents best professional practice. This is justified by the regulatory requirement to act in the client's best interest and to provide advice that is compliant with federal tax laws, ensuring that retirement income is minimized for tax purposes and that estate assets are passed on efficiently. An incorrect approach would be to solely focus on maximizing immediate tax deductions without considering the long-term implications for retirement income taxation or estate value. This could lead to recommendations that, while reducing current taxable income, result in higher taxes during retirement or increase the taxable estate. Another incorrect approach would be to recommend aggressive tax avoidance strategies that skirt the edges of IRS regulations, potentially exposing the client to audits, penalties, and interest. Furthermore, recommending products or strategies without a thorough understanding of their tax treatment under current U.S. law, such as mischaracterizing the taxability of life insurance death benefits or retirement plan distributions, would be a significant regulatory and ethical failure. Professional reasoning in such situations should follow a structured process. First, thoroughly understand the client's financial situation, goals, and risk tolerance. Second, identify relevant tax laws and regulations pertaining to retirement income and estate planning in the U.S. Third, evaluate various financial products and strategies for their tax efficiency and compliance. Fourth, present a clear, well-reasoned recommendation to the client, explaining the benefits, risks, and tax implications of each proposed strategy. Finally, ensure all recommendations are documented and comply with fiduciary duties and regulatory requirements. Question 4. Cost-benefit analysis shows that allowing members to access out-of-network providers without a prior referral from their primary care physician, PCP, for services not available within the network could increase overall healthcare expenditures. However, the plan is structured as a point-of-service POS plan, which combines features of both health maintenance organizations, HMO, and preferred provider organizations, PPO. Under this specific POS plan design, members are generally required to obtain a PCP referral for any out-of-network services to be considered for coverage, even if those services are not available within the network. Which of the following approaches best aligns with regulatory compliance and the operational framework of this POS plan? Option A. Require a PCP referral for out-of-network services to be considered for coverage, consistent with the plan's hybrid design and regulatory expectations for transparency. Option B. Inform members that out-of-network coverage is discretionary and subject to ad hoc approval based on cost-benefit analysis for each case. Option C. Cover out-of-network services without a PCP referral as long as the services are not available within the network to maximize member flexibility. Option D. Deny coverage for all out-of-network services, regardless of PCP referral, to strictly control costs. The correct answer is D. Deny coverage for all out-of-network services, regardless of PCP referral, to strictly control costs. Explanation. This scenario is professionally challenging because it requires balancing the cost-effectiveness of a POS plan with the regulatory obligations and ethical considerations surrounding member access to care, particularly when services are sought outside the network. The AFLMI framework emphasizes consumer protection and fair practices, meaning that while cost containment is a valid business objective, it cannot come at the expense of members' ability to receive necessary medical attention or be misled about coverage. The core tension lies in how a POS plan, designed to offer flexibility, is administered in a way that aligns with both its inherent design and the governing regulations. The correct approach involves clearly communicating the conditions under which out-of-network services will be covered, specifically the requirement for PCP referrals. This aligns with the regulatory expectation that plan members are provided with accurate and understandable information about their benefits and the processes required to access them. By requiring a PCP referral for out-of-network care, the plan is essentially operationalizing the hybrid nature of a POS plan, where the PPO component allows for out-of-network access, but the HMO-like gatekeeping mechanism, PCP referral, is maintained to manage costs and ensure continuity of care. This approach respects the member's choice while adhering to the plan's structure and regulatory mandates for transparency. An incorrect approach that fails to require a PCP referral for out-of-network services would be problematic. This would essentially allow members to access out-of-network care without the oversight intended by the POS design, potentially leading to higher, unmanaged costs for the plan and inconsistent care coordination. This could be seen as a misrepresentation of the POS plan's features and a failure to adhere to the operational framework that justifies its hybrid structure, potentially violating regulations that require plans to operate as described to members. Another incorrect approach, which is to deny coverage for all out-of-network services regardless of a PCP referral, fundamentally misunderstands and misrepresents the PPO aspect of a POS plan. This would be a direct violation of the plan's promise of out-of-network flexibility, even with a referral, and would likely contravene regulations concerning accurate disclosure of benefits and plan design. It would also create a significant barrier to care for members who, in good faith, sought out-of-network services under the assumption of coverage with a referral. The professional reasoning process for navigating such situations should involve a thorough review of the specific POS plan's design documents, the relevant AFLMI regulations concerning member communication, benefit disclosure, and network access. It requires understanding the intent behind the POS structure to offer a balance of cost control and flexibility. When faced with a decision about coverage for out-of-network services, the professional must ask, does the proposed action align with the plan's stated features? Is the member being provided with clear, accurate information about the process and potential financial implications? Does the action comply with all applicable AFLMI regulations regarding member rights and provider access? This systematic evaluation ensures that decisions are not only cost-effective, but also compliant and ethically sound. Question 5. Governance review demonstrates that a financial advisor, when discussing variable life insurance with a prospective client, presented a detailed overview of the policy's features, including the various subaccounts available for investment and the mechanics of policy loans. The advisor highlighted the potential for growth within the separate accounts and explained that policy loans could be taken against the cash value. However, the review noted that the advisor did not explicitly inquire about the client's risk tolerance or financial objectives prior to this presentation, nor did they elaborate on the potential for investment losses in the separate accounts or the impact of loan interest on the policy's cash value and death benefit. Which of the following approaches best aligns with the regulatory framework and ethical guidelines for offering variable life insurance? Option A. Focus the discussion primarily on the tax-deferred growth potential of variable life insurance and the flexibility of policy loans, without dwelling on potential investment losses or loan-related costs. Option B. Present a standardized presentation of all variable life insurance products and their investment options, emphasizing the potential for high returns to attract clients. Option C. Provide a comprehensive list of all available investment options within the separate accounts and explain the general process for taking policy loans, assuming the client will ask clarifying questions. Option D. Conduct a detailed client needs analysis, including risk tolerance and financial objectives, before presenting specific investment options and clearly explaining the risks and benefits of separate accounts and policy loans. The correct answer is D. Conduct a detailed client needs analysis, including risk tolerance and financial objectives, before presenting specific investment options and clearly explaining the risks and benefits of separate accounts and policy loans. Explanation. This scenario presents a professional challenge because it requires balancing the fiduciary duty to the client with the operational realities and regulatory requirements of offering variable life insurance products. The core of the challenge lies in ensuring that investment options presented to clients are suitable and that the associated risks, particularly those related to separate accounts and policy loans, are adequately disclosed and managed. The AFLMI jurisdiction emphasizes a client-centric approach, demanding that product recommendations and ongoing management align with the client's best interests and risk tolerance. The correct approach involves a thorough assessment of the client's financial situation, investment objectives, and risk tolerance before recommending specific investment options within a variable life insurance policy. This includes a clear explanation of how separate accounts function, the potential for both gains and losses, and the implications of utilizing policy loans, such as potential impact on cash value and death benefit. This approach is ethically and regulatorily sound because it prioritizes informed consent and suitability, aligning with the principles of acting in the client's best interest and avoiding misrepresentation, which are fundamental to the AFLMI framework. An incorrect approach would be to present a broad range of investment options without a personalized suitability assessment. This fails to meet the regulatory requirement of ensuring that the chosen investments are appropriate for the client's individual circumstances. Another incorrect approach would be to downplay or omit the risks associated with separate accounts, such as market volatility and the potential for principal loss, or to fail to adequately explain the consequences of policy loans, including potential lapsation or reduced death benefits. These omissions constitute misrepresentation and a breach of fiduciary duty, violating the spirit and letter of AFLMI regulations designed to protect consumers. Professionals should adopt a decision-making process that begins with a comprehensive client discovery phase. This involves active listening and detailed questioning to understand the client's financial profile and goals. Following this, a thorough product knowledge assessment is crucial, ensuring a deep understanding of the variable life insurance product's features, investment options, and associated risks. The recommendation phase must then directly link the client's profile to suitable investment choices and clearly articulate all associated risks and benefits. Ongoing monitoring and periodic reviews are also essential to ensure the policy remains aligned with the client's evolving needs. Question 6. The control framework reveals that when advising a client on utilizing an irrevocable life insurance trust (ILIT) to mitigate estate tax liability, what is the most critical element to ensure the life insurance proceeds are effectively removed from the grantor's taxable estate? Option A. The ILIT must be established with a significant cash value to offset future premiums. Option B. The ILIT must be structured to allow the grantor to receive income from the trust. Option C. The grantor must relinquish all incidents of ownership over the life insurance policy to the ILIT. Option D. The ILIT must be named as the sole beneficiary of the life insurance policy. The correct answer is C. The grantor must relinquish all incidents of ownership over the life insurance policy to the ILIT. Explanation. The control framework reveals that managing client expectations regarding the estate tax implications of life insurance, particularly when utilizing an irrevocable life insurance trust (ILIT), requires a nuanced understanding of both tax law and fiduciary duties. The professional challenge lies in accurately advising clients on how an ILIT can effectively remove life insurance proceeds from their taxable estate, while also ensuring that the trust is structured and administered in a manner that aligns with the client's overall estate plan and avoids unintended tax consequences or legal challenges. This scenario demands a deep understanding of the Internal Revenue Code (IRC) as it pertains to estate taxes and the specific provisions governing ILIT, as well as the ethical obligation to provide competent and comprehensive advice. The correct approach involves clearly explaining to the client that an ILIT, when properly established and funded, can achieve the objective of removing the life insurance death benefit from their gross estate for federal estate tax purposes. This is achieved by the grantor relinquishing all incidents of ownership over the policy, meaning they no longer have the right to change beneficiaries, surrender the policy, or borrow against its cash value. The trustee, who is a separate legal entity, then owns the policy. The regulatory justification stems from the Internal Revenue Code, specifically sections like IRC Section 2042, which defines what constitutes incidents of ownership, and the general duty of care owed to clients in financial and estate planning matters. Competent advice requires accurate representation of how legal and financial instruments function to achieve stated goals. An incorrect approach would be to suggest that simply naming an ILIT as the beneficiary of a life insurance policy is sufficient to remove it from the estate without the grantor also relinquishing all incidents of ownership. This fails to acknowledge the critical legal requirement that ownership, not just beneficiary designation, determines estate inclusion. The regulatory failure here is providing incomplete and misleading advice regarding estate tax avoidance strategies, potentially leading the client to believe their estate tax liability has been reduced when it has not. Another incorrect approach would be to advise the client that the ILIT will automatically shield the proceeds from estate taxes regardless of how the trust is structured or funded, without emphasizing the need for proper drafting and adherence to the terms of the trust agreement. This overlooks the potential for the grantor's retained interests or control over the trust to cause the proceeds to be included in the estate, a concept addressed by various IRC sections related to grantor trusts and retained interests. The ethical failure is a lack of due diligence and a failure to provide comprehensive advice that accounts for all relevant legal nuances. A further incorrect approach would be to focus solely on the estate tax benefits without discussing the potential gift tax implications of transferring the policy into the ILIT or making premium payments. While the primary goal might be estate tax reduction, neglecting to inform the client about other tax considerations, such as gift tax on the initial transfer or subsequent premium payments, constitutes a failure to provide holistic advice. This overlooks the interconnectedness of tax laws and the fiduciary duty to inform clients of all material tax consequences. A professional reasoning process for similar situations should involve a thorough assessment of the client's estate and financial goals, a detailed understanding of the relevant tax laws, including estate, gift, and generation skipping transfer taxes, and a clear explanation of how specific trust structures, like ILIT, operate to achieve those goals. Professionals must also consider the administrative aspects of trusts and the fiduciary responsibilities of the trustee. This requires ongoing education and a commitment to providing advice that is both legally sound and ethically responsible, always prioritizing the client's best interests and ensuring they have a complete understanding of the implications of their decisions. Question 7. The assessment process reveals that a small business client, employing 45 individuals, is seeking to establish a retirement savings plan for its employees. The business owner is looking for a plan that is relatively simple to administer and cost-effective, while also providing a meaningful retirement benefit for their staff. The financial advisor is considering various options to present to the client. Which of the following approaches best aligns with the client's stated needs and the regulatory framework for retirement plans for small businesses with fewer than 100 employees? Option A. Propose a traditional 401(k) plan, highlighting its flexibility and contribution types. Option B. Suggest a SEP IRA, as it is generally simpler to administer for small businesses. Option C. Recommend a simple IRA, ensuring the employer understands their obligation to either match employee contributions up to 3% of compensation or make a non-elective contribution of 2% of compensation for all eligible employees. Option D. Advise the client to allow employees to open their own individual retirement accounts without employer involvement. The correct answer is C. Recommend a simple IRA, ensuring the employer understands their obligation to either match employee contributions up to 3% of compensation or make a non-elective contribution of 2% of compensation for all eligible employees. Explanation: this scenario is professionally challenging because it requires a financial advisor to navigate the specific eligibility and operational requirements of simple IRAs for a small business client, while also ensuring compliance with relevant regulations. The advisor must balance the client's desire for a cost-effective retirement plan with the legal obligations and fiduciary responsibilities associated with offering such a product. Careful judgment is required to avoid misrepresenting the plan's features or failing to meet the employer's responsibilities, which could lead to penalties and harm the employee's retirement savings. The correct approach involves accurately assessing the business's employee count and understanding the employer's mandatory contribution obligations. This aligns with the regulatory framework for simple IRAs, which are designed for employers with fewer than 100 employees and have specific rules regarding employer contributions, either a matching contribution or a non-elective contribution. By recommending a plan that adheres to these contribution requirements and ensuring the employer understands their role, the advisor upholds their fiduciary duty and ensures the plan's compliance. An incorrect approach that suggests a SEP IRA would be professionally unacceptable because SEP IRAs have different eligibility criteria and contribution rules, and are not specifically designed for the small business context that simple IRAs target. Recommending a plan that does not fit the client's employee count or the specific intent of the simple IRA legislation would be a regulatory failure. Another incorrect approach that proposes a 401(k) plan without considering the administrative complexity and cost for a small business would also be a failure, as simple IRAs are often chosen for their simplicity and lower administrative burden compared to traditional 401(k)s. Finally, an approach that focuses solely on employee choice without emphasizing the employer's mandatory contribution obligations would be a significant regulatory and ethical failure, as the employer's commitment is a cornerstone of the simple IRA structure. Professionals should approach such situations by first thoroughly understanding the client's business size and objectives. They should then consult the specific regulations governing retirement plans for small businesses, such as those pertaining to simple IRAs, SEP IRA, and 401(k)s. The decision-making process should prioritize compliance, suitability for the client's needs, and the advisor's fiduciary responsibilities, ensuring all parties understand their roles and obligations. Question 8. The efficiency study reveals that a significant portion of plan members are utilizing out-of-network providers, resulting in higher than anticipated claims costs for the organization due to the differential in reimbursement rates. As a representative of the Life Management Institute, you are tasked with developing communication strategies to address this trend. Considering the ethical obligations to plan members and the need for financial prudence. What is the most appropriate approach to inform members about the cost implications of out-of-network coverage? Option A. Proactively provide plan members with clear, easily accessible information detailing the cost differences between in-network and out-of-network services, including potential out-of-pocket expenses, and guide them on how to access this information and understand their benefits before seeking care. Option B. Focus marketing materials solely on the benefits and convenience of in-network providers, without explicitly detailing the financial consequences of choosing out-of-network options. Option C. Update the plan documents to include a brief mention of higher out-of-network costs in a section dedicated to provider networks, assuming members will review these documents thoroughly. Option D. Implement a policy that automatically denies all out-of-network claims exceeding a certain threshold, without prior notification to members about this specific financial risk. The correct answer is A. Proactively provide plan members with clear, easily accessible information detailing the cost differences between in-network and out-of-network services, including potential out-of-pocket expenses, and guide them on how to access this information and understand their benefits before seeking care. Explanation. This scenario presents a professional challenge because it requires balancing the financial interests of the organization with the ethical obligation to provide accurate and transparent information to plan members. The AFLMI designation implies a commitment to upholding professional standards in the life insurance and financial services industry, which includes acting in the best interest of clients and adhering to regulatory disclosure requirements. The core of the dilemma lies in how to present information about preferred provider organization, PPO, plan coverage, specifically the higher costs associated with out-of-network services, without misleading or unduly alarming plan members, while still fulfilling the duty of care. The correct approach involves clearly and proactively communicating the financial implications of choosing out-of-network providers. This means providing plan members with readily accessible information that details the cost differences, potential for higher out-of-pocket expenses, and the process for understanding these differences before seeking care. This approach aligns with ethical principles of transparency and informed consent, and it is supported by regulatory frameworks that mandate clear communication of plan benefits and limitations. Specifically, regulations often require insurers to provide clear, understandable summaries of benefits and coverage, including any limitations or exclusions, and to ensure that marketing materials do not misrepresent the scope or cost of services. By emphasizing the proactive provision of information and empowering members to make informed decisions, this approach upholds the fiduciary duty and promotes member satisfaction and trust. An incorrect approach would be to downplay or obscure the cost differences for out-of-network services. This could manifest as burying this information in lengthy policy documents, using vague language, or focusing primarily on the in-network benefits without adequately highlighting the financial consequences of deviating from the network. Such an approach would be ethically problematic as it fails to provide members with the full picture, potentially leading to unexpected financial burdens and dissatisfaction. From a regulatory standpoint, this could be considered a violation of disclosure requirements, as it may mislead members about the true cost of their healthcare coverage. Another incorrect approach would be to present the cost information in a way that is overly alarming or discouraging, potentially leading members to avoid necessary out-of-network care even when it might be medically appropriate or the only available option. While transparency is crucial, the presentation should be balanced and informative, not fear-inducing. This could be seen as an ethical failure to support members in navigating their healthcare choices, and could also raise regulatory concerns if it is perceived as a tactic to steer members away from certain providers or services without proper justification. The professional decision-making process for similar situations should involve a thorough understanding of the plan's benefit structure, including the financial implications of both in-network and out-of-network coverage. It requires consulting relevant regulatory guidelines and ethical codes to ensure all communications are compliant and uphold professional integrity. Professionals should prioritize clarity, accuracy, and completeness in all member communications, using plain language and providing multiple avenues for members to access and understand the information. This includes developing communication strategies that empower members to make informed choices about their healthcare utilization and associated costs, thereby fostering trust and fulfilling the organization's responsibilities. Question 9. Governance review demonstrates that an underwriter is evaluating a life insurance application where the applicant has provided a recent medical examination report indicating a pre-existing condition that was not fully disclosed in the initial application. The applicant is employed in a profession generally considered low risk, and the proposed beneficiary is a close family member. The underwriter is considering approving the policy based on the applicant's stable employment and familial relationship with the beneficiary, without further investigation into the medical discrepancy or the financial justification for the sum assured, which approach best aligns with sound underwriting principles and regulatory compliance for the Associate Life Management Institute (AFLMI) framework. Option A. Decline the policy due to the undisclosed medical condition, as this represents a material misrepresentation that voids the application. Option B. Request further medical information to clarify the pre-existing condition and its impact on the risk profile, and conduct a thorough financial underwriting to assess the appropriateness of the sum assured in relation to the applicant's financial circumstances and the beneficiary's insurable interest. Option C. Approve the policy with a rider excluding coverage for the pre-existing condition, assuming the applicant's employment and beneficiary relationship are sufficient indicators of insurable interest. Option D. Proceed with policy approval, as the applicant's stable employment and familial relationship with the beneficiary suggest a low risk and a clear insurable interest. The correct answer is D. Proceed with policy approval, as the applicant's stable employment and familial relationship with the beneficiary suggest a low risk and a clear insurable interest. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the need to accurately assess risk with the ethical and regulatory obligation to treat applicants fairly and avoid discrimination. The underwriter must navigate the complexities of medical history, financial stability, and the fundamental principle of insurable interest, all within the strict confines of the Associate Life Management Institute (AFLMI) regulatory framework. Careful judgment is paramount to ensure that underwriting decisions are based on objective risk factors and not on subjective biases or incomplete information. The correct approach involves a thorough and objective assessment of all provided information, including the medical examination results and the applicant's financial documentation, to determine if a genuine insurable interest exists and if the risk profile aligns with the insurer's underwriting guidelines. This approach is justified by the AFLMI emphasis on fair underwriting practices, which mandate that decisions be based on established risk factors and not on discriminatory grounds. The principle of insurable interest, a cornerstone of life insurance, requires that the policyholder suffer a financial loss if the insured event occurs, and this must be demonstrable and legitimate. Adhering to these principles ensures that the insurer is not exposed to speculative or wagering contracts, and that the applicant is not being insured for reasons that do not align with the purpose of insurance. An incorrect approach would be to solely rely on the applicant's stated occupation as a proxy for risk, without verifying the medical examination results. This fails to uphold the duty of due diligence in risk assessment, and could lead to insuring an individual with undisclosed health conditions, thereby exposing the insurer to unacceptable risk. Furthermore, it bypasses the critical step of confirming the medical evidence, which is a primary component of underwriting. Another incorrect approach would be to dismiss the financial underwriting entirely because the applicant has a stable job. Financial underwriting is crucial to ensure that the proposed sum assured is commensurate with the applicant's financial circumstances, and that there is no incentive for speculative insurance. Ignoring this aspect could lead to overinsurance, which is an indicator of potential moral hazard and is contrary to sound underwriting principles. A third incorrect approach would be to assume insurable interest solely based on the applicant's relationship to the proposed beneficiary, without verifying the nature and extent of that relationship and the potential financial loss. While familial relationships often imply insurable interest, it is not an automatic presumption. The underwriter must confirm that the beneficiary has a legitimate financial stake in the continued life of the insured, aligning with the principle that insurance is intended to indemnify against loss, not to create a windfall. The professional reasoning process for similar situations should involve a systematic review of all application components, cross-referencing medical information with lifestyle disclosures, and evaluating financial capacity against the requested coverage. Professionals should always prioritize adherence to regulatory guidelines and ethical principles, seeking clarification or additional information when any aspect of the application raises concerns. The decision-making framework should be one of objective risk evaluation, ensuring fairness to the applicant and protection for the insurer. Question 10. The audit findings indicate that a life insurance agent has been consistently recommending the inclusion of multiple riders on new policies without a documented process for assessing client needs or clearly explaining the specific benefits and limitations of each rider. Specifically, the agent frequently suggests the accidental death benefit rider, waiver of premium rider, guaranteed insurability rider, accelerated death benefit rider, term rider, and child term rider. Which of the following approaches best aligns with regulatory requirements and ethical best practices for recommending these riders? Option A. Include a standard package of riders on all new policies to simplify the sales process and ensure clients benefit from a comprehensive suite of coverage, with minimal individual explanation required. Option B. Focus on explaining only the most prominent benefit of each rider, such as the payout for accidental death or the premium waiver, without delving into the specific conditions, exclusions, or potential cost implications. Option C. Conduct a detailed client needs analysis to determine if the benefits of each rider align with the client's specific financial situation, risk tolerance, and future objectives, and provide clear, comprehensive explanations of each rider's terms, conditions, costs, and potential impact on the policy. Option D. Prioritize recommending riders that are most frequently purchased or that offer higher commission potential, ensuring a basic overview of their general purpose is provided to the client. The correct answer is C. Conduct a detailed client needs analysis to determine if the benefits of each rider align with the client's specific financial situation, risk tolerance, and future objectives, and provide clear, comprehensive explanations of each rider's terms, conditions, costs, and potential impact on the policy. Explanation. This scenario is professionally challenging because it requires the agent to navigate the complexities of multiple life insurance riders and their implications for policyholders, while adhering strictly to the regulatory framework governing life insurance sales and advice. The agent must understand the specific benefits and limitations of each rider, as well as the potential for misrepresentation or omission of crucial information, which could lead to regulatory violations and harm to the client. Careful judgment is required to ensure that the recommended riders are suitable for the client's needs, and that the client fully understands the terms and conditions. The correct approach involves a thorough needs analysis of the client's financial situation, risk tolerance, and future goals, followed by a clear and accurate explanation of how each rider addresses those specific needs. This includes detailing the benefits, costs, and any limitations or exclusions associated with the accidental death benefit rider, waiver of premium rider, guaranteed insurability rider, accelerated death benefit rider, term rider, and child term rider. The agent must ensure that the client understands the purpose and impact of each rider on the overall policy, and that the decision to include or exclude them is informed and voluntary. This aligns with regulatory requirements for suitability, disclosure, and fair dealing, ensuring the client's best interests are prioritized. An incorrect approach would be to recommend riders based on sales targets or perceived ease of sale without a proper needs analysis. For example, recommending an accidental death benefit rider without assessing the client's actual risk of accidental death or the cost-benefit relative to other coverage would be a failure of suitability. Similarly, pushing a waiver of premium rider without explaining the conditions under which it activates or the potential for increased premiums on the base policy would be a misrepresentation. Recommending a guaranteed insurability rider without clarifying the future purchase options and associated premium increases could mislead the client about future costs. Suggesting an accelerated death benefit rider without fully explaining the conditions for early payout and the reduction in the death benefit would be a failure of disclosure. Offering a term rider or child term rider without understanding the client's specific need for temporary coverage or coverage for dependents would be a failure of needs-based selling. All these approaches violate ethical obligations and regulatory mandates for fair and honest representation of insurance products. Professionals should employ a decision-making framework that prioritizes client needs and regulatory compliance. This involves conducting a comprehensive fact-finding process, thoroughly understanding the product features and limitations, clearly communicating all relevant information to the client, documenting all recommendations and client decisions, and continuously updating their knowledge of regulations and product offerings. Question 11. The risk matrix shows a moderate likelihood of a conflict of interest arising when advising a close personal friend, who is also a prospective client seeking life insurance. The friend has casually mentioned that their spouse works for a specific insurance provider and has expressed a preference for that provider's products. The advisor is aware of other providers that might offer more competitive terms for this client's specific needs. Which of the following approaches best navigates this ethical and regulatory challenge? Option A. Focus solely on the products offered by the friend's spouse's employer, as this demonstrates loyalty to the friend's connection and simplifies the advisory process. Option B. Proceed with advising the friend, but proactively disclose the potential conflict of interest to the friend, and explain that all recommendations will be based solely on the friend's best interests and a comprehensive needs analysis, independent of any external preferences or potential personal benefits. Option C. Share the friend's personal financial situation and insurance needs with the friend's spouse, believing it might help the spouse guide the friend towards a suitable product from their employer. Option D. Assume the friend's preference for their spouse's employer's products is well informed and proceed to recommend those products, as it aligns with the friend's stated inclination and avoids potential awkwardness. The correct answer is B. Proceed with advising the friend, but proactively disclose the potential conflict of interest to the friend, and explain that all recommendations will be based solely on the friend's best interests and a comprehensive needs analysis, independent of any external preferences or potential personal benefits. Explanation. This scenario presents a common ethical challenge in life insurance advisory roles, specifically concerning the balance between client needs and potential conflicts of interest, while upholding patient confidentiality and informed consent. The professional challenge lies in navigating a situation where a personal relationship could inadvertently influence professional judgment, potentially compromising the client's best interests and violating regulatory obligations. Careful judgment is required to ensure that all advice and actions are solely driven by the client's needs and regulatory compliance, not by personal gain or obligation. The correct approach involves prioritizing the client's well-being and adhering strictly to regulatory frameworks regarding patient confidentiality and informed consent. This means obtaining explicit consent before sharing any information, even with a close acquaintance, and ensuring that any product recommendations are based on a thorough assessment of the client's needs and financial situation, free from any personal bias or undue influence. This aligns with the principles of fiduciary duty and ethical conduct expected of life insurance professionals. An incorrect approach would be to assume consent based on a personal relationship and disclose sensitive client information. This directly violates patient confidentiality regulations, which mandate strict protection of client data. Another incorrect approach is to recommend a product that may not be the most suitable for the client's needs simply because it offers a personal benefit or aligns with the acquaintance's interests. This constitutes a conflict of interest, breaching ethical guidelines and potentially regulatory requirements that demand advice be in the client's best interest. Failing to fully explain the product's features, benefits, and risks, or pressuring the client into a decision also undermines the principle of informed consent, leaving the client vulnerable and uninformed. Professionals should employ a decision-making framework that begins with identifying potential ethical dilemmas and conflicts of interest. They must then consult relevant regulatory guidelines and internal company policies, prioritizing client interest above all else, seeking explicit consent for any information sharing, and ensuring transparency and full disclosure are paramount. If a conflict of interest is unavoidable or perceived, the professional should disclose it to the client and potentially recuse themselves from the situation or seek guidance from a supervisor or compliance officer. Question 12. Process analysis reveals that a client nearing retirement has expressed a strong desire to purchase a variable annuity, citing its potential for growth. However, the client's financial profile indicates a low risk tolerance and limited understanding of investment market volatility. What is the most appropriate course of action for the financial advisor? Option A. Recommend an immediate annuity to provide guaranteed income. As the client is nearing retirement, regardless of their specific product preference. Option B. Proceed with the variable annuity recommendation as requested by the client, emphasizing its growth potential to meet their stated desire. Option C. Conduct a comprehensive needs analysis to determine if a variable annuity is truly suitable, considering the client's risk tolerance, financial goals, and time horizon, and present alternative annuity options if necessary. Option D. Focus on explaining the complex fee structure and investment options within the variable annuity to ensure the client is fully informed before purchase. The correct answer is C. Conduct a comprehensive needs analysis to determine if a variable annuity is truly suitable, considering the client's risk tolerance, financial goals and time horizon, and present alternative annuity options if necessary. Explanation. Scenario analysis. This scenario presents a common challenge in financial advisory where a client's stated needs may not fully align with their financial capacity or risk tolerance, particularly concerning complex products like annuities. The challenge lies in balancing the client's expressed desire for a specific product with the advisor's fiduciary duty to recommend suitable options that genuinely serve the client's best interests, adhering strictly to regulatory guidelines. Misinterpreting or oversimplifying the client's situation can lead to unsuitable recommendations, potentially resulting in financial harm to the client and regulatory repercussions for the advisor. Correct approach analysis. The correct approach involves a thorough needs analysis that goes beyond the client's initial request. This includes a comprehensive assessment of their financial goals, risk tolerance, time horizon, and existing financial situation. For annuities, this means understanding the nuances of fixed, variable, and indexed annuities, and determining which, if any, aligns with the client's specific circumstances. If the client's stated preference for a variable annuity, for instance, is not supported by their risk tolerance or financial capacity, the advisor must explain why it is not suitable and present alternative options that are. This aligns with the regulatory framework for suitability, which mandates that recommendations must be in the client's best interest, considering all relevant factors. Ethical practice dictates transparency and a commitment to educating the client about their choices and the implications of each product. Incorrect approach is analysis, recommending the variable annuity solely based on the client's expressed preference without a thorough suitability assessment, fails to uphold the client's best interest. This approach disregards the regulatory requirement to ensure that the product is appropriate for the client's individual circumstances, potentially exposing them to risks they do not understand or cannot bear. It prioritizes a superficial client request over a comprehensive fiduciary duty, suggesting an immediate annuity without understanding the client's liquidity needs or long-term income goals is also problematic. Immediate annuities are designed for income generation starting soon after purchase, which may not be appropriate if the client requires access to their principal or has different financial objectives. This misapplication of annuity types can lead to a product that does not meet the client's actual needs. Focusing exclusively on the potential for higher returns of a variable annuity without adequately explaining the associated risks and fees is a failure in disclosure and suitability. The regulatory framework requires clear and understandable explanations of product features, benefits, and risks. This approach prioritizes sale over client understanding and protection. Professional reasoning. Professionals should approach client recommendations by first establishing a deep understanding of the client's financial profile and objectives through a detailed needs analysis. This analysis should inform the selection of suitable products. When a client expresses a preference for a specific product, the advisor's role is to evaluate that preference against the suitability criteria and the client's best interests. If the preference is not suitable, the advisor must clearly articulate the reasons why and present appropriate alternatives, ensuring full transparency regarding product features, risks, and costs. This process is guided by regulatory mandates for suitability and ethical principles of client-centric advice. Question 13. The control framework reveals that a closely held corporation's success is heavily dependent on its founder, who also serves as the chief innovator and primary sales driver. The founder is considering options to protect the business from the financial repercussions of their untimely death or disability. Which of the following represents the most prudent and comprehensive approach to address these concerns, aligning with best practices in life insurance and business planning? Option A. Recommend a key person insurance policy with a death benefit sufficient to cover the estimated lost profits and recruitment costs for a replacement, and ensure the buy-sell agreement is funded by this policy to facilitate a smooth ownership transition. Option B. Suggest that the founder purchase a personal life insurance policy for a significant amount, with the proceeds intended to support their family, assuming this indirectly benefits the business. Option C. Propose a key person insurance policy with a minimal death benefit, primarily to cover immediate operational expenses, and suggest the buy-sell agreement be funded through a long-term loan from surviving partners. Option D. Advise the founder to simply increase the company's general cash reserves to absorb potential financial shocks. The correct answer is A. Recommend a key person insurance policy with a death benefit sufficient to cover the estimated lost profits and recruitment costs for a replacement, and ensure the buy-sell agreement is funded by this policy to facilitate a smooth ownership transition. Explanation. The control framework reveals a common challenge in business planning: ensuring continuity and financial stability when a key individual is lost. This scenario is professionally challenging because it requires a nuanced understanding of both business operations and life insurance products, specifically key person insurance and buy-sell agreements, to protect the business from significant financial disruption. The AFLMI designation implies a need for adherence to specific regulatory guidelines and ethical considerations within the life insurance industry. The correct approach involves a comprehensive assessment of the business's reliance on the key individual and the potential financial impact of their absence. This includes quantifying the financial loss the business would incur, such as lost profits, recruitment costs, and potential business failure. Based on this assessment, the appropriate amount of key person insurance coverage should be recommended. Furthermore, the business owner's objectives for succession and the financial needs of surviving owners or heirs must be considered when structuring buy-sell agreements, ensuring that the business can be transferred smoothly and equitably. This approach aligns with the regulatory requirement to act in the client's best interest, providing advice that is suitable and addresses their specific needs and risks. It also reflects ethical obligations to provide accurate and comprehensive information regarding financial products and their application in business planning. An incorrect approach would be to recommend a generic or arbitrary amount of key person insurance without a thorough needs analysis. This fails to meet the regulatory standard of suitability and could leave the business underinsured, exposing it to significant financial risk. Ethically, it demonstrates a lack of due diligence and a failure to prioritize the client's financial well-being. Another incorrect approach would be to focus solely on the buy-sell agreement, without adequately addressing the liquidity needs that key person insurance can provide to fund such an agreement. This oversight could lead to a situation where the buy-sell agreement cannot be executed due to a lack of funds, potentially jeopardizing the business or the financial security of the deceased owner's estate. This is a failure to provide holistic advice. A third incorrect approach would be to recommend a policy that does not align with the specific terms and funding mechanisms of the buy-sell agreement. For instance, if the buy-sell agreement requires a specific payout amount, the key person insurance policy should be structured to provide that liquidity. Failing to coordinate these elements demonstrates a lack of understanding of how these financial tools work together to achieve the business owner's objectives and could lead to unintended consequences. The professional decision-making process for similar situations should begin with a deep understanding of the client's business, their reliance on key individuals, and their long-term business objectives. This involves active listening, asking probing questions, and conducting thorough financial analysis. Subsequently, the advisor must identify relevant financial tools, such as key person insurance and buy-sell agreements, and explain their benefits and limitations in the context of the client's specific situation. The recommendation should be tailored, well justified, and clearly communicated, ensuring the client understands the rationale behind the proposed solutions and can make an informed decision. Adherence to regulatory requirements for suitability and ethical principles of client best interest are paramount throughout this process. Question 14. Strategic planning requires an insurer to develop a comprehensive managed care strategy, considering the principles of utilization review, case management, and disease management. Which of the following approaches best aligns with regulatory expectations and ethical obligations for ensuring appropriate patient care while managing costs? Option A. Establishing a dedicated team of registered nurses and physicians to conduct thorough medical necessity reviews for all proposed treatments, coordinating care for members with chronic conditions through personalized case management plans, and developing targeted disease management programs based on population health data. Option B. Implementing a strict pre-authorization process for all elective procedures exceeding a specific dollar amount, with denials automatically issued if the provider cannot immediately justify the cost-effectiveness based on projected long-term savings. Option C. Relying solely on a third-party claims processing system to flag claims for potential overutilization, with minimal human intervention in the review process. Option D. Limiting the number of specialist visits a member can access per year to a fixed, low number, regardless of the member's specific medical condition or physician recommendations. The correct answer is B. Implementing a strict pre-authorization process for all elective procedures exceeding a specific dollar amount, with denials automatically issued if the provider cannot immediately justify the cost-effectiveness based on projected long-term savings. Explanation. This scenario is professionally challenging because it requires balancing cost containment with the ethical and regulatory obligation to ensure appropriate patient care. The AFLMI framework emphasizes the importance of responsible managed care practices that do not compromise member health outcomes. A key challenge lies in distinguishing between necessary medical services and those that may be considered excessive or experimental, a determination that must be guided by established clinical protocols and regulatory mandates. The correct approach involves a comprehensive review process that prioritizes evidence-based medicine and patient well-being. This entails utilizing trained clinical professionals to assess the medical necessity and appropriateness of proposed treatments, aligning with the principles of utilization review. Case management should then be employed to coordinate care for members with complex health needs, ensuring they receive timely and effective interventions. Disease management programs, when integrated, further support proactive care and improved outcomes for specific chronic conditions. This integrated approach is ethically sound as it aims to optimize care while managing resources, and it aligns with regulatory expectations for insurers to provide access to medically necessary services. An incorrect approach would be to solely focus on cost reduction without adequate clinical oversight. For instance, automatically denying services based on a predetermined cost threshold, irrespective of medical necessity, would violate ethical obligations to members and likely contravene regulatory requirements for fair claims processing and access to care. Another incorrect approach would be to delegate utilization review decisions to non-clinical staff without a clear escalation path to qualified medical professionals, potentially leading to inappropriate denials and a failure to meet the standard of care. Furthermore, neglecting to implement case management for high-cost or complex cases could result in fragmented care, increased overall costs due to complications, and a failure to meet the insurer's duty of care. Professional decision-making in such situations requires a systematic process. First, clearly define the scope of the managed care program and its objectives, ensuring alignment with both financial goals and member health. Second, establish robust clinical review criteria based on current medical evidence and guidelines. Third, ensure that all utilization review, case management, and disease management activities are conducted by qualified personnel with appropriate training and oversight. Fourth, maintain transparent communication with members and providers regarding review processes and decision-making criteria. Finally, regularly audit and evaluate the effectiveness of these programs to ensure they are achieving desired outcomes without compromising patient care or regulatory compliance. Question 15. What factors determine the most appropriate retirement savings and withdrawal strategy for a client, considering their individual circumstances and the need for long-term financial security? Option A. The client's immediate desire for access to a significant portion of their retirement savings for discretionary spending. Option B. The advisor's personal investment preferences and the availability of high-commission products. Option C. A focus solely on maximizing short-term investment returns without considering the client's overall retirement needs or potential market volatility. Option D. A comprehensive assessment of the client's current financial status, projected retirement expenses, risk tolerance, and time horizon, leading to a diversified and suitable savings and withdrawal plan. The correct answer is D. A comprehensive assessment of the client's current financial status, projected retirement expenses, risk tolerance, and time horizon, leading to a diversified and suitable savings and withdrawal plan. Explanation: this scenario is professionally challenging because it requires balancing a client's immediate desires with their long-term financial security and the fiduciary duty owed to them. The AFLMI designation implies a commitment to ethical conduct and client well-being, necessitating a thorough understanding of retirement planning principles and regulatory expectations. The advisor must navigate potential conflicts between a client's perception of their needs and the objective reality of their financial situation, ensuring that recommendations are suitable and aligned with regulatory requirements. The correct approach involves a comprehensive assessment of the client's current financial situation, future income needs, risk tolerance, and time horizon. This includes analyzing existing assets, potential liabilities, and projected expenses during retirement. Based on this holistic review, the advisor can then recommend a diversified retirement savings strategy that aligns with the client's goals and regulatory guidelines. This approach is ethically sound and compliant with regulatory frameworks that mandate suitability and a client-centric focus in financial advice. It prioritizes the client's best interest by ensuring that recommendations are grounded in a thorough understanding of their circumstances and the long-term implications of their financial decisions. An incorrect approach would be to solely focus on the client's stated desire for immediate access to funds without a thorough assessment of the long-term consequences. This could lead to recommendations that deplete retirement savings prematurely, jeopardizing the client's financial security in their later years. Such an approach would likely violate regulatory principles of suitability and fiduciary duty, as it prioritizes short-term client wishes over their long-term financial well-being. Another incorrect approach would be to recommend overly aggressive investment strategies without adequately considering the client's risk tolerance. This could expose the client to undue financial risk, potentially leading to significant losses that could hinder their retirement goals and contravene regulatory requirements for prudent investment advice. Finally, an approach that neglects to consider the impact of inflation and healthcare costs on retirement income would be fundamentally flawed, as it fails to account for critical factors that significantly influence the sustainability of retirement plans. Professionals should employ a structured decision-making process that begins with active listening and thorough data gathering. This involves understanding the client's stated goals and underlying needs. Subsequently, a comprehensive analysis of the client's financial profile, including assets, liabilities, income, and expenses, is crucial. This analysis should be followed by an evaluation of various retirement planning strategies, considering their suitability, risk, and potential impact on the client's long-term financial security. Regulatory requirements and ethical considerations should guide every step of this process, ensuring that recommendations are always in the client's best interest. Question 16. Examination of the data shows that a company's 401(k) plan administrator has identified a recurring issue where employee salary deferrals are not being deposited into the plan trust until several weeks after the payroll deduction date, and employer matching contributions are sometimes delayed by a full payroll cycle. Furthermore, there are instances where employees leaving the company have received less invested employer contributions than their records indicate they should have received, due to what appears to be an inconsistent application of the plan's cliff vesting schedule. The administrator needs to implement a corrective action plan. Which of the following approaches best addresses these implementation challenges while ensuring regulatory compliance and fiduciary responsibility? A. Immediately implement a new payroll deduction processing system that automatically transmits employee deferrals to the plan trust within 3 business days of the payroll date, and establish a fixed schedule for depositing employer matching contributions no later than the 15th business day of the month following the payroll period. Simultaneously, conduct a comprehensive review of all past vesting calculations and recalculate any discrepancies, ensuring future vesting is applied strictly according to the plan document's cliff vesting provisions, and that employees receive clear annual statements detailing their vested balances. B. Advise the company to temporarily suspend all employer matching contributions until the deferral deposit issues are resolved, and inform employees that vesting calculations will be reviewed and potentially adjusted to align with a more conservative interpretation of the plan document to mitigate future risks. C. Continue the current practice of depositing employee deferrals as soon as administratively feasible, which is typically within the month following payroll, and inform employees that any discrepancies in vested employer contributions are due to the complexity of the cliff vesting schedule and may not be rectifiable. D. Focus solely on correcting the employee deferral deposit timeline by implementing a new system, and address the employer matching and vesting issues only if they become a significant source of employee complaints, as the primary concern is the timely deposit of employee money. Option A. Continue the current practice of depositing employee deferrals as soon as administratively feasible, which is typically within the month following payroll, and inform employees that any discrepancies in vested employer contributions are due to the complexity of the cliff vesting schedule and may not be rectifiable. Option B. Focus solely on correcting the employee deferral deposit timeline by implementing a new system, and address the employer matching and vesting issues only if they become a significant source of employee complaints, as the primary concern is the timely deposit of employee money. Option C. Immediately implement a new payroll deduction processing system that automatically transmits employee deferrals to the plan trust within 3 business days of the payroll date, and establish a fixed schedule for depositing employer matching contributions no later than the 15th business day of the month following the payroll period. Simultaneously, conduct a comprehensive review of all past vesting calculations and recalculate any discrepancies, ensuring future vesting is applied strictly according to the plan document's cliff vesting provisions, and that employees receive clear annual statements detailing their vested balances. Option D. Advise the company to temporarily suspend all employer matching contributions until the deferral deposit issues are resolved, and inform employees that vesting calculations will be reviewed and potentially adjusted to align with a more conservative interpretation of the plan document to mitigate future risks. The correct answer is C. Immediately implement a new payroll deduction processing system that automatically transmits employee deferrals to the plan trust within 3 business days of the payroll date, and establish a fixed schedule for depositing employer matching contributions no later than the 15th business day of the month following the payroll period. Simultaneously, conduct a comprehensive review of all past vesting calculations and recalculate any discrepancies, ensuring future vesting is applied strictly according to the plan document's cliff vesting provisions, and that employees receive clear annual statements detailing their vested balances. Explanation. This scenario presents a common implementation challenge for employers sponsoring 401(k) plans, specifically concerning the accurate and timely application of employee contributions and employer matching, alongside the correct administration of vesting schedules. The challenge lies in ensuring compliance with the Employee Retirement Income Security Act of 1974, ERISA, and the Internal Revenue Code, IRC, while maintaining employee trust and operational efficiency. Mismanagement can lead to significant penalties, fiduciary breaches, and damage to employee relations. The correct approach involves establishing clear internal processes and controls that ensure employee deferrals are deposited into the plan trust within the legally mandated timeframe, typically no later than the 15th business day of the month following the payroll period in which the deferrals were made, or as soon as administratively practicable if sooner. Employer matching contributions must also be deposited in a timely manner, aligning with the plan document and regulatory requirements. Vesting schedules must be accurately applied to determine an employee's ownership of employer contributions, ensuring that employees receive their vested benefits upon termination or other triggering events as defined by the plan. This approach upholds fiduciary duties, promotes fairness, and ensures compliance with ERISA's stringent reporting and disclosure requirements. An incorrect approach of delaying the deposit of employee deferrals, even if the employer intends to make them up later, violates ERISA requirement for prompt deposit of participant contributions. This delay can be construed as a prohibited transaction and a breach of fiduciary duty, as the funds are considered plan assets once withheld from an employee's pay. Another incorrect approach of inaccurately calculating or applying the employer matching contribution or misinterpreting the vesting schedule can lead to underpayment of benefits to employees. This not only results in financial harm to participants, but also constitutes a failure to administer the plan according to its terms and regulatory mandates, potentially leading to lawsuits and penalties. A third incorrect approach of failing to properly document and track employee service for vesting purposes, or not providing timely and accurate information to employees regarding their vested balances, undermines transparency and can lead to disputes and compliance issues. Professional decision-making in such situations requires a thorough understanding of the plan document, ERISA, and IRC regulations. It involves implementing robust internal controls, regular audits of contribution processing and vesting calculations, and clear communication channels with plan participants and service providers. When discrepancies arise, the professional must prioritize immediate correction, adherence to regulatory timelines, and transparent communication with all stakeholders. Question 17. When evaluating a client's request for life insurance, which approach best aligns with regulatory requirements and ethical obligations for recommending a suitable product from the spectrum of term, whole, universal, variable, variable universal, and indexed universal life insurance? Option A. Suggesting a complex product like variable universal life insurance due to its potential for higher cash value growth, assuming the client is interested in investment opportunities. Option B. Focusing on whole life insurance as it provides a guaranteed death benefit and cash value, which is a universally safe and beneficial choice for all clients. Option C. Presenting a detailed comparison of all available product types, explaining their unique features, benefits, risks, and suitability based on the client's stated financial goals, risk tolerance, and long-term objectives. Option D. Recommending the product with the lowest initial premium, such as term life insurance, as it is generally the most straightforward and cost-effective option for most clients. The correct answer is C. Presenting a detailed comparison of all available product types, explaining their unique features, benefits, risks, and suitability based on the client's stated financial goals, risk tolerance, and long-term objectives. Explanation. This scenario is professionally challenging because it requires an insurance agent to balance a client's stated financial goals with the inherent complexities and varying features of different life insurance products. The agent must act in the client's best interest, adhering to regulatory requirements that mandate suitability and disclosure. Misrepresenting or oversimplifying product features can lead to regulatory violations and ethical breaches. The correct approach involves thoroughly understanding the client's needs, risk tolerance, and financial objectives, and then matching these to the most appropriate life insurance product. This requires a detailed explanation of the features, benefits, and limitations of each suitable option, particularly highlighting the differences between term life, whole life, universal life, variable universal life, and indexed universal life insurance. The agent must ensure the client comprehends the long-term implications of each choice, including premium structures, cash value accumulation potential, investment risk, where applicable, and death benefit guarantees. This aligns with regulatory frameworks that emphasize client suitability, full disclosure, and preventing misrepresentation. For example, regulations typically require agents to assess a client's financial situation, insurance needs, and objectives before recommending a product. Failure to do so, or recommending a product that does not align with these factors, can result in disciplinary action. An incorrect approach would be to recommend a complex product like variable universal life insurance solely because it offers higher potential returns, without adequately assessing the client's risk tolerance or explaining the associated investment risks and fees. This fails to meet the suitability requirements and could be construed as misrepresentation if the risks are not clearly communicated. Another incorrect approach would be to recommend only term life insurance because it has the lowest initial premium, without exploring if the client's long-term financial plan might benefit from the cash value accumulation features of permanent life insurance, such as whole life or universal life. This could be a failure to explore all suitable options that might better serve the client's overall financial well-being. Recommending indexed universal life insurance without clearly explaining how the index crediting mechanism works, its caps and floors, and the potential for limited growth compared to other investment vehicles, would also be a failure of disclosure and suitability. Professionals should employ a decision-making framework that prioritizes client needs. This involves active listening to understand the client's situation, conducting a thorough needs analysis, educating the client on available product types and their implications, presenting suitable options with clear explanations of features and risks, and documenting the recommendation process and client's decision. This systematic approach ensures compliance with suitability and disclosure regulations and upholds ethical standards. Question 18. The monitoring system demonstrates that a group life insurance policy, which includes term life, accidental death and dismemberment (AD&D), and dependent coverage, is in place for employees of a company. An employee has recently resigned. The employee's spouse contacts the insurance professional inquiring about the continuation of their dependent coverage, stating they were unaware that their coverage might be affected by the resignation. The insurance professional needs to determine the most appropriate course of action. Option A. Inform the employee that dependent coverage will automatically continue for a period of 30 days after the termination date, regardless of policy specifics. Option B. Advise the employee to immediately enroll in a new individual life insurance policy without first reviewing the group policy's provisions for dependent coverage. Option C. Tell the employee that dependent coverage is a separate policy and is not affected by the primary insured's employment status. Option D. Advise the employee that dependent coverage typically ceases upon termination of employment and provide information on any conversion rights or grace periods as stipulated in the group policy documents. Correct answer is D. Advise the employee that dependent coverage typically ceases upon termination of employment and provide information on any conversion rights or grace periods as stipulated in the group policy documents. Explanation. This scenario presents a professional challenge because it requires the insurance professional to balance the employer's desire for cost efficiency with the fiduciary duty to ensure adequate coverage for employees and their dependents, all within the strict confines of the Associate Life Management Institute (AFLMI) regulatory framework. The AFLMI designation implies a commitment to ethical conduct and adherence to specific industry standards, which are paramount when dealing with group insurance products like term life, accidental death and dismemberment (AD&D), and dependent coverage. The core of the challenge lies in interpreting and applying the group policy provisions accurately to a situation where a change in employee status impacts coverage. The correct approach involves a thorough review of the group policy's specific terms and conditions regarding dependent coverage termination and the grace periods or conversion options available. This aligns with the AFLMI emphasis on client-centric service and regulatory compliance. Specifically, it requires understanding that dependent coverage is often contingent on the primary insured's eligibility, and that termination of the primary insured's employment typically triggers a change in dependent coverage status. The professional's duty is to inform the employee of their rights and options, which may include conversion to an individual policy or continued coverage under specific circumstances outlined in the policy. This upholds the ethical obligation to provide accurate information and facilitate informed decision-making for the policyholder, ensuring compliance with any applicable state insurance laws or group policy mandates that govern such transitions. An incorrect approach would be to simply assume dependent coverage ceases immediately upon the employee's termination, without verifying the policy details. This could lead to a lapse in coverage for dependents who may still be eligible for a grace period or conversion rights, potentially exposing the employee to significant financial risk and the insurer to claims disputes. Ethically, this demonstrates a lack of due diligence and a failure to act in the best interest of the insured. Another incorrect approach would be to provide incomplete information about conversion options, such as only mentioning the possibility of conversion without detailing the specific requirements, timelines, or costs. This misleads the employee and hinders their ability to make an informed choice, violating the principle of transparency and fair dealing. A third incorrect approach would be to advise the employee that dependent coverage automatically continues indefinitely, which is factually inaccurate for most group policies and would create a false sense of security, leading to potential future complications and dissatisfaction. The professional decision-making process for similar situations should begin with a comprehensive understanding of the group policy's provisions related to termination of employment and its impact on all types of coverage, including term life, AD&D, and dependent coverage. This involves consulting the policy documents, any applicable riders, and relevant state insurance regulations. The next step is to communicate clearly and accurately with the employee, explaining their rights, obligations, and available options, such as conversion privileges, grace periods, or alternative coverage. This communication should be documented to ensure a clear record of advice provided. Finally, The professional must ensure that any actions taken are in strict accordance with the policy terms and regulatory requirements, prioritizing the employee's understanding and access to appropriate coverage. Question 19. Compliance review shows that a long-term employee, MS, Anya Sharma, recently experienced a qualifying event due to a reduction in her work hours, which resulted in her losing eligibility for the employer-sponsored group health insurance plan. The HR department has received notification of this change, but has not yet sent MS Sharma the required information regarding her continuation of coverage options. The review also noted that the HR department has been discussing MS Sharma's health status with the plan's third-party administrator to determine the exact premium cost for her potential continuation coverage. What is the most appropriate course of action for the employer to ensure compliance with federal regulations? Option A. Immediately provide MS Sharma with a comprehensive COBRA election notice detailing her continuation coverage options, premium costs, and election deadline, while ensuring all discussions with the third-party administrator regarding her health information adhere to HIPAA privacy and security standards. Option B. Wait for the third-party administrator to finalize all premium calculations and provide MS Sharma with a complete package of information, including any potential eligibility for other employer-sponsored plans, before issuing any COBRA notices. Option C. Inform MS Sharma that her eligibility for continuation coverage is pending internal review and that she will be notified once a decision is made regarding the exact premium costs and coverage details. Option D. Proceed with providing MS Sharma with a basic notification of her COBRA rights, but defer the detailed premium and coverage information until the third-party administrator has confirmed all figures, to avoid any potential inaccuracies. The correct answer is A. Immediately provide MS Sharma with a comprehensive COBRA election notice detailing her continuation coverage options, premium costs, and election deadline, while ensuring all discussions with the third-party administrator regarding her health information adhere to HIPAA privacy and security standards. Explanation. This scenario presents a common challenge in employee benefits administration, ensuring compliance with complex regulations when an employee experiences a qualifying life event. The professional challenge lies in accurately identifying the employee's rights and the employer's obligations under both COBRA and HIPAA, particularly when there's a potential for misinterpretation of the plan's provisions or the employee's circumstances. Careful judgment is required to avoid both overcompliance, which can lead to unnecessary costs, and undercompliance, which can result in significant penalties and legal liabilities. Correct approach involves a thorough understanding of COBRA continuation coverage requirements and HIPAA privacy and security rules. Specifically, upon notification of a qualifying event, like termination of employment, the employer must promptly provide the former employee with a COBRA election notice. This notice must clearly outline the available coverage options, the duration of coverage, the cost to the individual, and the deadline for making an election. Simultaneously, the employer must ensure that the employee's protected health information, FI, is handled in accordance with HIPAA, meaning any information shared with a third-party administrator or insurer must be done with appropriate safeguards and business associate agreements in place. This approach prioritizes the employee's rights and the employer's legal obligations, ensuring a smooth transition of benefits and adherence to privacy standards. An incorrect approach would be to delay providing the COBRA election notice, citing a need for further internal review or awaiting confirmation of the employee's eligibility. This failure directly violates COBRA timely notice requirements, which can lead to penalties and the potential for the employee to claim coverage from the date of the qualifying event. Another incorrect approach would be to provide incomplete or misleading information on the COBRA notice, such as omitting details about the cost of premiums or the election deadline. This misrepresentation can also lead to legal challenges and financial repercussions. Furthermore, failing to ensure that any communication or data transfer regarding the employee's health status or coverage is HIPAA compliant. For instance, by sharing sensitive information without proper authorization or security measures, would constitute a significant breach of privacy regulations. Professionals should employ a decision-making framework that begins with a clear understanding of the triggering event and the relevant regulatory frameworks, COBRA and HIPAA in this case. They should then consult the specific plan documents and seek clarification from legal counsel or benefits experts if any ambiguity exists. A systematic process of information gathering, verification, and timely action, coupled with robust internal controls and training, is essential to navigate these situations effectively and maintain compliance. Question 20. Regulatory review indicates that a client is seeking to open a Roth IRA and has expressed understanding that their contributions will be made after tax. When explaining the benefits of this account type, which of the following approaches most accurately reflects the regulatory framework for Roth IRAs, focusing on after-tax contributions, tax-free growth, and qualified distributions? Option A. Emphasize that while contributions are made with after-tax dollars, the primary tax advantage is the potential for tax-free growth of earnings and tax-free qualified distributions in retirement, provided specific IRS conditions are met. Option B. Advise the client that all earnings within the Roth IRA can be withdrawn tax-free at any time, regardless of how long the account has been established or the reason for withdrawal. Option C. Inform the client that they can choose to treat their after-tax contributions as pre-tax contributions and deduct them in a future tax year if they meet certain income limitations. Option D. Explain that since contributions are made after tax, the client will be eligible to claim a tax deduction for these contributions on their current year's tax return. The correct answer is A. Emphasize that while contributions are made with after-tax dollars, the primary tax advantage is the potential for tax-free growth of earnings and tax-free qualified distributions in retirement, provided specific IRS conditions are met. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of Roth IRA rules, specifically distinguishing between after-tax contributions and the tax-free growth and qualified distribution benefits. The challenge lies in correctly advising a client on the implications of their contribution strategy, ensuring compliance with IRS regulations, and maximizing the client's tax advantages without misrepresenting the product's features. Careful judgment is required to avoid errors that could lead to tax penalties for the client and professional repercussions for the advisor. The correct approach involves accurately explaining to the client that while Roth IRA contributions are made with after-tax dollars, the primary tax benefit is the tax-free growth of earnings and tax-free qualified distributions in retirement. This approach correctly emphasizes the long-term tax advantages of the Roth IRA structure. This aligns with IRS regulations governing Roth IRAs, which define contributions as non-deductible after tax and qualified distributions as tax-free, provided certain conditions are met. Ethically, it is paramount to provide accurate and complete information to enable informed client decisions. An incorrect approach would be to suggest that the after-tax nature of contributions means the client will receive a tax deduction in the current year. This is a fundamental misunderstanding of Roth IRAs, as their tax benefit is realized in retirement, not at the time of contribution. This misrepresentation violates IRS rules regarding Roth IRA contributions and could lead to the client incorrectly claiming a deduction, resulting in penalties and interest. Another incorrect approach would be to imply that all earnings within a Roth IRA are immediately tax-free upon withdrawal, regardless of whether the distribution is qualified. This fails to acknowledge the IRS requirement for distributions to be qualified. Generally, account held for at least 5 years an owner is at least 59.5, disabled or deceased, to be tax-free. Failing to explain this qualification requirement can lead to the client incurring taxes on earnings they believed would be tax-free, creating a significant financial and trust issue. A further incorrect approach would be to conflate Roth IRA contributions with traditional IRA contributions, suggesting that the client can choose to deduct their contributions later. Roth IRA contributions are irrevocably made on an after-tax basis and cannot be converted into deductible contributions. This error demonstrates a lack of understanding of the distinct tax treatments of Roth and traditional IRAs, leading to potentially misleading advice and noncompliance with IRS guidelines. The professional reasoning process for similar situations should involve 1. Thoroughly understanding the specific product features and their associated regulatory framework, in this case, IRS rules for Roth IRAs. 2. Clearly differentiating between contribution types, after-tax vs. pre-tax, and their immediate versus deferred tax implications. 3. Emphasizing the conditions required for tax-free growth and qualified distribution. 4. Communicating this information to the client in a clear, accurate, and understandable manner, avoiding jargon and potential misinterpretations. 5. Always prioritizing client education and informed decision-making over making assumptions or providing incomplete information.